Hi, I'm Alison from FX Scout. So today we're going to be discussing a topic that frustrates traders everywhere: stop hunting. If you've ever had a trade that hit your stop loss by just a few pips and then reversed and went in the other direction, then you're not imagining things. That is stop hunting at work. In this video, we'll explore what stop hunting is, why it occurs, how you can recognize it, and then how you can even turn it to your advantage. Remember that Forex trading is risky and that most traders lose money. This video is for educational purposes only. So what is stop hunting? Stop hunting refers to a market move designed to trigger a cluster of stop loss orders sitting around key technical levels. And once these stops are activated, they often create a surge of buying or selling pressure, temporarily moving the market before reversing direction. Now, this isn't just theory. It happens because many retail traders place their stops in obvious places, which means that they're open to be taken advantage of, and they're vulnerable in these positions. For example, you'll often see price dip slightly below a recent support level or wick just above a resistance line and then reverse sharply. That's the hunt. It's a temporary breach to reset liquidity and clear out the playing field. Now, this isn't always a malicious move. It can just be the natural rhythm of the market. But it's especially common during news events, pairs with low trading volume, and those pairs with very low liquidity. So why does stop hunting happen? Now, there are a few core reasons why stop hunting occurs, and understanding these will help you to really prevent yourself from being caught up in a stop hunting liquidity grab. So number one is liquidity harvesting. Your stop loss is basically a pending order, which means that by pushing price to that level, they trigger those orders, get the liquidity they need, and then they let the market reverse. Number two is crowded stop zones. Retail traders generally place their stops at very obvious places. This is usually around key levels or round numbers like 1.3000. And these zones become magnets for price spikes, especially if the market has been consolidating. Number three is false breakouts. So a classic sign of a stop hunt is a false breakout. So this is where the market breaks out of a key zone, hits the stops, and then reverses. Traders who jumped in expecting a trend continuation are now stopped out or trapped. Now, what's important to understand is that it's not just about flushing you out. These moves help the big players position themselves better. Once your stop is hit, they often step in the other way and then ride the move that you were hoping for, but they ride it at a better price. Now I want to talk about how to identify areas where stop hunting might occur before it happens. So number one is around clustered technical levels. You want to look for places where price has respected the same level multiple times. For example, triple tops, triple bottoms, clean horizontal support and resistance zones. These areas attract stop losses like magnets. Next, something I've mentioned before is psychological round numbers. So big numbers like the 1.000 level, 1.1 level, or 150 level on JPY pairs are emotional and visual anchors. Many traders set their stops around these areas, which makes them prime hunting grounds. Next is obvious chart patterns. So common trading patterns like the head and shoulders, flags, or ranges often attract stop loss placement just beyond their edges. Next is wicky price action. So you want to watch for sharp candle wicks, those long shadows that push briefly into stop zones and then reverse. These can happen on all time frames, but where you're most likely to see them is on the 5, 15, or hourly charts. So you don't need to guess where everyone would place their stop. You just need to ask yourself, if I were new to trading, where would I place my stop? These are where most people have their stops and where you'll be most vulnerable to stop hunting. Now let's talk about protection. You're not going to be able to avoid all stop hunts, but you can place wiser trades to prevent most of your stops being triggered. Number one is to widen your stop. And if you're going to do this, please remember to reduce your position size. So you might want to avoid placing your stops at obvious technical levels. Place them just beyond those levels, accounting for price volatility. Then you want to use the ATR or average true range to place your stops. This also helps you to account for the normal volatility of the market. If you're placing your stops within that volatility range, you're more likely to get stopped out than if you place them just beyond that range. Next, you want to wait for the trap to spring. So instead of buying right at support or selling at resistance, wait to see if the market wicks through these levels and reverses. Enter after the false breakout, not during it. Then you can also use time of day as a filter. Stop hunts often happen at the open of the market, just before major economic news announcements, or thin liquidity periods like Friday afternoons. You want to be cautious during these periods. Remember, the goal isn't to have a perfect stop loss. It's to place it just beyond where the big players are looking to fish you out. Stop hunting is real, but it's not magic. It's just the market looking for where the money is. Thank you so much for watching. If you enjoyed this video, please remember to subscribe and like, and leave us a comment in the comment section below, and I'll see you in the next video.